How am I preparing for the upcoming property market slowdown? Well, that was a question posed to me by Jarrad Mahon for his Perth Property Insiders podcast. Jarrad's the go-to guy for property management and investment in Perth, but we discussed much more than what's happening in Western Australia. And that's why I asked if I could share the recordings of that show with you, which is what you're about to be hearing, because we discuss what I believe is ahead for our property markets, what I'm doing personally to protect myself, what you can do to ensure you make the most of the current market, and to ensure you don't become a casualty of the economic and property changes ahead. So welcome to this episode of the Michael Yardney podcast, because my intention is to give you more clarity and direction on what's ahead.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Welcome along to Perth Property Insider, Michael. It's always great to have a chat with you.
It's fun to be back. Thanks, Jarrad.
Now, the reason I wanted to get you on is that we can kind of get brought into a false sense of security when everything's going great in the markets. And, you know, when we're investing during a boom, we tend to feel like a bit of a hero, don't we?
Yeah. Well, anyone could buy a property last year, go away on holidays. Not that you could because COVID stopped us. And when you came back, your property would be worth a lot more than when you went away. So you felt smart.
And it masks a lot of other potential issues with property selection. You know, people are doing renovations or development and thinking that they're doing those things well.
It covered up a lot of mistakes, Jarrad. And last year I saw a lot of people take shortcuts because of FOMO. And unfortunately, some of those will come to roost this year when they've made decisions that maybe they're going to regret moving forward.
And when we look around the country, we can definitely see that Melbourne and Sydney are slowing down overall. And there seems to still be some upside for Brisbane, Adelaide and my hometown of Perth. But I always like to look ahead and not just be focusing on the present. And I think we can learn a lot from you, having been through a number of cycles in the past. You've got a few more grey hairs than me, just a few.
Just a little few, yep.
I'm catching up with you.
Good on you.
I think it's really important for us to look ahead and start to think about how to play a stronger defence and some of the things to consider to get our house in order. So that's why I got you on.
Thank you. Well, let's start with what's currently happening, because Sydney and Melbourne have been the first capital cities to record negative monthly growth rates this year, according to the CoreLogic figures. And in fact, Hobart in April started to drop as well after many months of consecutive growth. But we've got to remember there's not one Melbourne property market. There's not one Sydney property market. So within each of those capital cities, there are micro markets. There are markets within markets. There are houses, there's townhouses, there's apartments, there's the inner city, there's middle ring suburbs, there's affluent and the first home buyer market. So it's wrong to say Melbourne and Sydney are falling. It's a bit like saying I've got one hand in a bucket of hot water, Jarrad, and another in a bucket of cold water, and on average I feel okay. Some areas are still doing well, and other areas, unfortunately, property values are dropping. And what it's shown this year, and it's not surprising, is that it's predominantly the upper end, the most expensive properties in Melbourne and Sydney, and to be frank, Canberra as well a bit, and also the inner city, the apartment markets that are suffering. But Jarrad, it's not unusual for the high end, the most affluent suburbs to outperform and have bigger swings. So during the boom times, they've done particularly well because people's businesses are doing well, their incomes were going well, they had multiple streams of income. So in general, we tend to see stronger performance from the premium end of the market through the growth phase of the cycle. But then when the softer conditions come, historically, not just this time, the more expensive end of the market tends to lead the downswing, just like it led the upswing. And that's what we're currently seeing at the moment, Jarrad.
Yeah, seeing similar things in Perth, even though we're trailing behind the other capitals. That pattern has existed in the past, and I can see it folding out now as well.
Sure. So if we look back at previous cycles. I guess it's first of all important to understand that properties do move in cycles. Now, in Perth, that's much harder because you've had a very, very flat period because you had an excessive boom leading up to this tougher time. And we've spoken before, and I'm sure you've informed your clients and the listeners about why the Perth market has underperformed moving forward. But the bottom line really is every boom leads to the next downturn, just like every downturn leads to the next upswing. And what's happened is in many parts of Australia, property values grew 20%, often 30% over the last couple of years, despite the pandemic, despite the closed borders, despite people not coming into the country because of very low interest rates, because of the government stimulus, because people had jobs. And in fact, it was a cycle of upgraders, Jarrad. People who were tenants became first home buyers. First home buyers, people who had their homes upgraded, wanted better homes. They wanted backyards. They didn't want to live in apartments. Millennials moved to household formation age. Baby boomers bought themselves a holiday home because they couldn't go overseas. So the last couple of years was, yes, characterised by these great number of property purchases and, interestingly, not as many investors. But during that time, overall, wages growth was minimal, over 3-5%. And so it had to stop at some stage because eventually affordability is going to be the issue, which is what slowed things down, not interest rates, not rising interest rates. And this time around, not even the actions of APRA last year, because in previous cycles, it's been the tightening of credit that stopped the market from moving forward.
Makes sense. So how do we look ahead and what do we do to protect our downside and position us to have that stronger defense?
Well, people are asking me, when is it going to stop? How long is the market going to go on like this? And I guess the other big question is the property market going to crash? Because you only have to look at any article online, any of the newsletters, and they're going to tell you the banks are suggesting that rising interest rates are going to drop the property markets in late this year or maybe 2023. I mean, there's always the negative Nellies and the property pessimists who've always suggested that. And there's no doubt that we are now moving to the slowdown phase of the cycle. But that doesn't mean that the value of your home, my home, is going to drop. All properties are going to drop. I really can't see the property market crashing. See, for the property market to crash 10, 15, 20%, like some of the people are saying, Jarrad, people have to actually sell their homes and there's nobody there to buy them and they've got to sell at any price. But there's no need at the moment. We don't have desperate sellers. And yes, interest rates are going to go up. And yes, some people are going to have some mortgage stress. But can I just go through a couple of reasons why I don't think the property market's going to crash, Jarrad?
Yeah, that would be great.
Well, first of all, despite the pandemic and despite all the issues, the average Australian is wealthier than ever. Interestingly, the CBA Bank, who is on the one hand saying property values are going to fall, are suggesting that during the lockdowns, Australians have socked away something like 230 billion with a B in excess savings, leading to a massive war chest. Some have got cash, amazingly. They're keeping cash, no idea why. Some have got money in their offset accounts. So they've got savings. At the same time, of course, as we said, the value of their homes have gone up, so they've got more equity. And combining that, we've actually got strong superannuation, strong share portfolio. The average Australian is wealthier than they ever have been. And last year, the residential property market increased significantly. It went up to about $7 billion to close to $1 trillion in property market. And there's about, at the moment, $2 trillion worth of loans. So overall, the property market has got a very low, 20% loan to value ratio. And Jarrad, 50% of all home owners have no mortgage. Your parents, my parents, older people who had their homes from, I shouldn't say my parents, I apologize, me and my parents unfortunately have passed away, but people of my generation who bought their homes 30, 40 years ago or bought homes and paid their homes off. So in general, the property market overall has a very low loan to value ratio, and in general, people have got a war chest and the net wealth of Australians has gone up. So yes, are they going to, property values going to drop a bit? Yeah, but that 50% of homeowners who don't even have a mortgage, they don't care that interest rates are going up. It doesn't affect them.
No.
And then of those who have got a mortgage, a lot who bought their properties 5, 10 years ago, Jarrad, they've actually got quite some equity in their property. And so therefore, they're not worried about mortgage costs as well. The ones who are going to hurt a bit with rising interest rates are the first homeowners who've got in with a 2% deposit, a 5% deposit with some of the schemes that have been around, and also investors who've overcommitted themselves. But there's currently, Jarrad, no sign of mortgage stress for the majority of borrowers. In fact, all the banks are saying again, most of their home loans are paid weeks, months, sometimes even years in advance. I think the other thing is, yes, interest rates are going to go up, but they can't stay at virtually zero. They were wartime, very low interest rates to push the market, to stimulate the market, to stop us falling into a recession during the COVID cocoon that we all experienced. And so therefore, they've now got to get up back to normal. But when they get to normal, the Reserve Bank doesn't want to crash the property market. No. It wants that about as much as it wants another case of another strain of coronavirus. So what it really is going to do is slow inflation down. But if it's learned anything, and I hope it has, it's not going to push interest rates up too much. And so therefore, they're going to get to neutral rather than stimulatory. Of course, if they do push them too high, unfortunately, it could slow the market too much. Now, everyone knows we've got new government and they've got new policies. There's one policy they've come up with, Jarrad, that worries me a bit. Can I share that with you?
Yeah, of course.
And that's the concept, and I don't disagree with it in principle, but the concept that there should be a minimal wage increase. Because if everybody gets more money, yes. I mean, as a business owner, you'd understand that. If everyone gets more money, that's going to be good for the economy. They're going to spend more.
Yeah, there's nothing wrong with that.
What that's going to do is push up inflation. And then, as a business owner, people are going to have to put up their costs because it's costing me more. And some businesses still haven't got margins enough to raise wages 5%. And what that's going to mean is more inflation as costs go up, as people spend more. And so what's the Reserve Bank going to do? It's going to raise interest rates to slow the inflation, and the cycle goes on. And I actually lived through the 1970s. I bought my first property in the 1970s, in the early 70s, when the Whitlam government came into power, the Labor government. And that's what we experienced, a period of very high inflation. Fantastic for me to start off with, because there wasn't all this information. I thought, why hadn't anyone told me about this before? All of a sudden I bought a property and it went up so much in value and the rents went up so much I could buy another one. And we had this inflationary wages spiral until eventually it had to be stopped. And that created a recession in the 80s. Most people know the big recession we had to have in the 90s, but there was one in the early 80s. And that taught me as a young investor, hey, the market doesn't always go up. So your question of what do we do to protect ourselves is a smart one, but I'm really just explaining that what the background is in my thought process before I give you an answer. So interest rates are low and they are going to go up, but when they do go up, they're only probably going to go up 1.5%, 2% overall, more. And that means, yes, your mortgage will go up a bit too, but everyone who borrowed in the last couple of years had the banks already check that they could cope with 2, if not 3% rise in interest rates. So yes, some people will be caught short, but that doesn't mean they've got to sell up. The bank doesn't want to sell you up. The Reserve Bank doesn't want the property market to crash. So the banks have been conservative in their lending criteria. And if you look at previous cycles, the history shows that rising interest rates haven't stopped the property market moving. Yeah. Because again, as I said, half the homeowners, it's not going to worry. The other half, it probably isn't going to worry as much. Other than the first home buyers and some some highly leveraged investors may have a little bit of trouble. What stopped the property market in the past has not been interest rates as much as credit tightening. The flow of credit when APRA got involved in 2016-17, when prior to that we used to have a credit squeeze. But what we're seeing on the ground around Australia is a huge shortage of properties, with more people going to come into the country because the government's now going to open the borders, bring people in because of the low unemployment rates, and most are going to live somewhere in the capital cities. Not many are going to go to the regional towns, and they're going to rent initially. And you know it, running a very large property management department for your clients, there's no vacancies anymore. No. There's nowhere for them to live. And this is going to underpin rentals, underpin our property markets, and investors are going to get back into the market as well. So why am I right and the experts wrong? Well, just look at what they said about the doomsday predictions at the beginning of COVID, and the debt bomb. Remember, that didn't explode, and the fiscal cliffs we were meant to fall off, and we didn't fall off that. Australia's economy is strong. Anyone who wants a job can get a job. And in fact, they're job hopping to get better wages. So yes, will the property market slow? Of course it will. We've had unprecedented growth that can't continue on. Will it crash? Probably not, other than certain sectors. And that is, sure, some first home buyers who've overcommitted are going to get themselves into trouble, and some investors who've borrowed too much and mortgage stress may affect them. They're the segments that could get into trouble, Jarrad.
Well, that makes a lot of sense when you look at the big picture and start to drill down on all the fundamentals as well.
But you ask, what can you do about it? I guess the answer is be prepared. Expect the worst, but plan for the best. So people say to me, well, when's the slowdown going to happen? And I say, it is going to happen, but I don't know. Are we going to have another recession, Michael? And the answer is, yes, we are. But I don't know when that's going to happen. Interest rates are going to go up. How high are they going to go? Well, yeah, they are going to go up. I don't know how high they're going to go. And that doesn't satisfy them. But I have expectations rather than forecasts. So knowing exactly when or how much is more a forecast. But by having the expectation that it's going to happen, Jarrad, it's made me a safer, more cautious investor so that I'm going to be prepared for that. So I have a plan. I have a strategy. Our clients at Metropole are all given a plan. And when we tell them, plan for your plan not to go to plan because things are going to go wrong along the way. So you've got to have financial buffers. Make sure.
That's the thing, isn't it? Because 90% of investors get stuck at 1 to 2 properties. And I think the stat is that a vast majority of them sell up within 5 years. So it's times like this that can, shake the boat. And those that don't have their plan and don't, haven't thought about protecting their downside with a strong defense, unfortunately, they can, be bounced out of the market for one reason or another. And then they don't end up building that larger portfolio and creating the wealth.
I guess a couple of reasons. One is finance. So I have personally locked in a large portion of our loans earlier this year. I should have done it last year, but I didn't think the rates were going to change as much. So that's a form of protection. Now, this is not advice for other people. I don't know their personal circumstances, but that's something you should speak to a proficient mortgage broker about. I own the sort of properties in the locations which are not going to suffer as much. So to me, I do live in one of the high-end suburbs, in a good street in one of the high-end suburbs. So my own home may go down in value a bit, but my properties, that's not an investment-grade property. It's a lovely place to live, but my investment-grade properties are in suburbs where people have got good income, higher disposable income, a large percentage of owner-occupiers, and people are wanting to live there. And so they're the areas that are going to hold their own more than the lower end. And this is not a judge of people, but the areas where people are living month to month, week to week. So the areas where my tenants are, people are paying a premium to live there because they're wanting to live there.
They want to be in the good
there because they're poor.
Close to the amenities.
Exactly. Schools, lifestyle, neighbourhood, lifestyle preferences to owning the right properties, and then having your financial buffers in place, insurance policy, which is something I learned in that first downturn of the 1980s when I wasn't prepared for it because no one even told me about those sort of things happening. So if people can get themselves ready and I guess have a long-term view, accept that in the short term, the market will go down, but in the long term, well-located capital city properties are going to keep increasing in value for two main reasons. Our population is going to grow significantly, Jarrad, and our nation is going to be wealthier, so we can afford to live in better, more expensive properties.
I guess the silver lining to all of this, Michael, is that anyone that's been purchasing a property over the last year would know how difficult it's been to find a quality investment grade property when, you've been competing against very emotional home buyers that have had the FOMO, seeing that there's going to be a lot more opportunity for us in this market to start purchasing properties and not have as much competition. And if your time horizon is 10 plus years, be selective and be prepared to hold for the long term. And as you say, when you look back at the historical patterns of growth in these investment grade locations, we don't have the crazy swings that other locations have had at the top end and at the bottom end. And, we can be more sure when purchasing it that the bottom's not going to fall out over the coming period as well. So I'm actually looking to be active in the side of the country at the moment. And I've got Brett on the search, and then I'm going to be moving back to Melbourne to purchase something as well. So
thank you for that. And thank you for trusting the team at Metropole to help you. But I agree with you that similarly, I'm active still because I'm not going to try and time the market. In fact, if things are on special at David Jones, your wife, mine probably goes to buy them because they're cheaper also. Not that they're going to drop a lot, but I'm going to only buy for us and for our clients the sort of properties that are going to not drop as much in value, but are going to be in continuous strong demand so that in 5 years you look back and say, gee, that was cheap then. But I remember, it wasn't that long ago, 2016, 17 and a bit of 18, when the property markets were flat because it was initially initially APRA tightening the screws, the Haynes Royal Commission. Then there was the talk about maybe negative gearing going. And those who were nervous during those times, look what they missed out on, while those who had a big picture view, look what their properties are worth today. And I can go back to the times after the global financial crisis when everyone thought the world was coming to an end, and 10 years earlier than that when there was a recession we had to have. Jarrad, I've sort of worked out that the world breaks probably once every decade, and then it sorts itself out.
Yeah. And boy, we can feel uncertain in those moments, can't we? And it can be really hard to take the action, but we can never also tell what's going to be exactly around the corner. So that's why I think taking that longer term view and buying properties that you would want to hold for that long term, you can't go wrong almost.
Exactly right. But I think the other thing is to have a plan, have a strategy, because if you don't have something, then it's just too easy to be swayed by the noise, by emotion, by what other people are doing. But if you've got a plan, then all you do is you do what you've got to do to execute it, as opposed to being swayed by all the noise, because we are going to get a lot more of it. There's already talk of recession. There's already talk of mortgage stress. Time to turn off that noise.
And then if you have your finances and your buffers and your insurances and your mindset right, and you're not watching too much news, I think we're going to get through this period with a lot more opportunities that we can take and not end up a statistic having to sell our property and not seeing the upside when things do come back around stronger again.
Well, somebody else is buying it because they think there's upside. So somebody's going to win from that equation. One of the interesting trends I've seen, and I thought it was maybe just my experience, but in fact, I've seen it come now over and over again and heard from many people, is that on the East Coast over the last couple of years, a lot of investors sold up. And that's one of the reasons why currently there are so few vacant properties and investment properties. So I know we, like you, manage a lot of properties for clients in Melbourne, Sydney and Brisbane, and people would ring out their property manager and say, I'm selling. Oh, no, look, would you like to have a chat with one of the property strategists? No. The estate agent just rang me and said he's got a buyer for my property. Of course he did. So they're not sticking to a plan. And what they did was their plan was to hold in the long term. And I read recently that with some of the very large estate agencies in Queensland and in Sydney, they've lost up to 15% of the properties on their rent roll that they were managing. And in general, they were being sold to home buyers, not investors. Now, these people have missed out, unfortunately, because they're going to have to pay capital gains tax. The property's done its job, gone up in value, so you don't sell up. But all this means moving forward, huge rental crisis, very strong rental growth. And that means that even if you're not going to get capital growth, for the next couple of years, you can start to look forward to higher cash flow, Jarrad.
Yeah, well, it's going to offset those interest rates that are rising as well. And I saw an interesting stats from Michael Matusik in his weekly missive showing that there's actually more investors selling than there is buying at the moment. So that rental crisis is only going to get worse.
Yes.
Which I feel for the tenants too, because when it's this tight, I'm not sure what your vacancy rates are like, but in Perth, we're sub 1%. And, we have tenants breaking down crying when they get given a rental property at the moment. And, it's not fun when it is this tight. But the flip side is that, we're increasing rents every time we go to market. Tenants are putting their applications in before we even do a viewing. You could put up a photo of a mailbox and probably get applications on it. And
so we're noticing houses on the East Coast have got vacancy rates below 1%. Apartments are now dropping to below 2%, even in the CBD.
Yes.
So it's when the vacancy rates drop below 2%.
The migrants really are attracted to that higher density living, and
very much so.
And the CBD here is making a comeback as well.
Sure. So we're experiencing a period of very strong rental growth, but like you, when we've got tenants there and we all of a sudden say, well, your rent has to go up. Unfortunately, I do feel sorry for them on the one hand, because they say, but my wages haven't gone up 10%. Why should my rent go up? But when you look at the comparables, there's actually very, very little for rent.
Yeah, it's hard to compare sometimes, isn't it?
Yes, it is. So this is the time that the landlords are not taking advantage of the people, because for the last couple of years, they've actually had to wear the hard times. So now it's time to just catch up because the rental yields are the lowest they've been for a long time because properties have gone up and values have gone up and rents haven't gone up proportionately, Jarrad.
So we've got a lot to look forward to. It's probably going to be a bit more bumpier times, but a lot of opportunity. And I really appreciate you giving us your thoughts on, first of all, the market not crashing and then how to play a bit more of a defensive game. And did you have anything to add before we finish up?
Yes, I'm confident and comfortable that residential real estate is still a great investment. But I also recognize that to become financially free in the future, property on its own is actually quite lumpy. It's difficult and it's not a high rental yield investment. So I would be suggesting anyone who's listening to this and wants to become financially free, have a plan, work out where you want to be, work out what you've got to do. And I guess the end game really should be to own your own home with no debt. You don't want to go into your golden years with debt on your home. Have a residential property portfolio at the end with a lowish loan to value ratio, so it's at least covering its face and washing its face, and then having some other cash flow income, whether it's shares, whether it's managed funds, whether it's your superannuation, whether it's commercial property. So just be careful of people selling you property and saying property only, or if they say shares only or Bitcoin, run away. You actually need a holistic approach to your long-term wealth creation. Over the last year or two, and it's probably now going to happen in Perth, that we experienced in the East Coast, a whole generation of young, new, let's call them enthusiastic amateurs giving advice. Everyone's got an opinion on property, but be careful whose advice you take.
Especially at this phase in the market, because as we've pointed out, the wrong property, when the tide goes out, we see who's swimming naked, don't we?
As famous Warren Buffett said, exactly right, Jarrad.
And that's a great quote to end on, I think. Thanks so much for your time, Michael. Really appreciate it.
My pleasure, Jarrad. Look forward to doing this again in a few months' time.
See ya.
I hope my chat with Jarrad gave you some insights. In a moment, I'm going to share my popular mindset message with you. But I just want to follow on my thought process when I spoke with Jarrad, because if you're thinking about adding to your property portfolio or buying a home this year, you're going to have to look at things a little bit differently. Especially if you're a property investor, you may have to change your strategy, if you have one, to cope with this new environment, because the next few years are going to be very, very different for property. But at Metropole, my team are committed to help you. So why not turn to the multi-award winning team to get independent, unbiased property and wealth advice? Because you see, we don't sell property. So as opposed to other buyers agents or property salespeople or marketers, we're going to tell you what's right for you. And even if you're not ready to get started today, we'll help you get your ducks in a row. Having the team at Metropole on your side could mean you're going to more safely outperform the market than the average investor and give your family the financial freedom you deserve. You see, our team uses frameworks and strategies that I've developed over 5 decades and that we've been helping clients with for over 20 years. In fact, our audited results show that Metropole's clients are 7.3 times more likely to own 6 or more properties than the average property investor. Now, wouldn't you like to get those sort of results? What would it be like if you could work with my team and outperform the average investor, even in these challenging times, because we've invested through these before. And if you're interested in buying your home, we're still going to be able to help you. So why not book a complimentary, obligation-free chat? Just go to metropole.com.au. And if you do become a client of Metropole, you'll have access to a very wide range of wealth services, not just property, but wealth advisory, financial planning, renovations, development, property management, business advisory. I look forward to being part of your ongoing wealth creation journey. Go to metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset moment, I want to explain to you why you shouldn't worry about your failures. Look, we all get things wrong. We all make mistakes. But I want to explain to you a couple of reasons why failing is overrated. Now, I've failed in all sorts of ways in my life, in my personal life, in my business life, even in my investments over the years. But let me again remind you why failing is overrated. First of all, failure is never permanent. That sinking feeling that you've got, that'll never last forever. The best way to reflect on your failures is to focus on the lessons that you've learned and the persons you're going to become, rather than spending your time trying to avoid failure. The less time you spend on rejection, the faster you're going to grow. The second way you should think about failure differently is to own up to your failures. The moment you openly talk about the things that make you vulnerable, they no longer have power over you. People will appreciate your honesty because everyone knows what it's like when they've had setbacks, when they've made mistakes. They're going to respect you for owning up to your problems and embracing your failures. And in the process, you will become stronger. Now, another reason why failing is overrated is the world won't change unless you do. The world owes you nothing. It was here first. We can't blame the shortfalls in our lives or other people around us or past decisions that we've made for how things are in the present. It's not the events that define who you are. It's how you choose to react to them. So forget what others are saying. They're never going to judge you anyway. They don't really care as much about what you're doing or how you performed like you think. But you do have to realise that if you want the world to change, you're going to have to change your ways first. Now, this is a common theme that comes through my mindset moments, isn't it? So the next question really is, how badly do you want it? Whatever it is that hasn't worked out. As Steve Jobs once said, if you don't love it, you're going to fail. We've all heard about Thomas Edison, who had 1,000, or supposedly 1,000 unsuccessful attempts at inventing the light bulb. But from his perspective, I didn't fail 1,000 times. He's said to have said that the light bulb was just an invention that took 1,000 steps to get there. So I'd like you to remember that just because you failed, it doesn't mean you're a failure. Never let failure deteriorate your self-worth. Now, I know it's easy to say and it's hard to think about it that way, but if your head hurts, you say, I've got a headache. You don't say, I am a headache. So failure is nothing more than an event. It doesn't mean you're a failure, so don't personalise it. And it's really important to recognise that failure is part of the process. The fastest way to success is to double your failure rate. Successful people have failed more times than a beginner has ever tried. If you want to succeed, fail faster. I often say I'm a real success at failure, but that's okay because I get up one more time, and so should you. So don't worry about your failures. Well, I hope you got some benefit from today's chat. Thanks for spending the last half an hour or so with us. And if you did get some benefit and you know someone else who'd also benefit, please tell them about the Michael Yardney podcast. At the bottom of every app, whatever you're listening to this on, there's a little button where you can share, tell somebody about it, or just tell them about it in the old-fashioned way. I'd, of course, love you to leave a review and tell the whole world about it, but my aim is to make as many people as financially independent as possible. So why not help me by letting other people know as well? And I've got a bonus for you for listening to this podcast. Go to podcastbonus.com.au and you can get a bundle of ebooks and reports. We've updated some of the reports so they may be useful for you in your wealth creation journey. Now, I'll be back again real soon, but you can catch me in between the shows on social media, and I'd love you to be part of my private Facebook group, which is growing every month, where every day I leave a snippet, a chart, something a bit different that you won't get elsewhere, just to help you understand a bit more about what's happening in the world, particularly of property, economy, and money. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?